The Money Show. Personal finance.
Warren Ingram from Galileo Capital is with us in studio once again this week, and you want to talk about markets because they're a funny old thing. You went away for a long weekend, and the JSE on Friday hit record levels. Naspers, of course, is a key provider of jet fuel to the markets, and Naspers hit record levels on Friday too. Then we have 3 days of declines and a bit of a bounce today. Tell me why it is important to stay invested in markets.
It's But I will. But just before that, if any of the big fund managers want to pay me to go on long weekends again, so the market can go up, no problem. We can discuss it.
Index investors are particularly grateful. Yes.
Yeah. So I think it's probably adding on to what we've been talking about, I think, on this show for the last 12 months. We've had the JSE, drifting sideways for a long period of time, 3.5 years. Investors in the stock exchange getting, pretty much cash-like returns, with all the volatility that comes with investing in shares. And then what we see is sort of a build-up, almost a momentum of sentiment from investors saying, why am I doing this? Why don't I just, put my money in cash and earn my interest, and at least it's certain, and it's, interest rates are not bad now, and et cetera, et cetera. And the message that we, and I think we've probably said this 3 or 4 times in the last 18 months, we don't know when things will turn, and we're not forecasting that the markets are going to jump up, next week or next month or whatever the deal is. But when things drift sideways in the JSE or any stock market, eventually what happens is that cycle turns, and you hope that it turns up as opposed to turning down. But what you know is it's not going to just carry on drifting in one direction. And if we look at what happened in the month of July, that's exactly what's happened. Is for the month, the stock exchange delivered a return of fractionally more than 7% in 1 month. And to give you a context, I mean, for the year, if you said, what happened from the 1st of August last year to the end of July this year, the JSE was up 7.6% roughly, 7.5%. And so that means that you've got your entire year's return in 1 month.
Yeah.
And there was absolutely nothing. We could have sat here in the month of June and looked at everything, and there would not have been a single indicator that would have said to us, this is the month, chaps, where the market's just going to shoot up and fill your boots and get ready. There wasn't anything particularly amazing about the month of July that drove the markets in a direction. I'm sure we can come up with some great reasons now with some hindsight, but there's no economic factors in South Africa that suddenly have made us a much better investment destination or whatever. This is the market. This is the nature of investing. It delivers these returns in these huge lumps from time to time. It's enormously frustrating, but it does that.
Yeah, it is frustrating, but it is then goes back to they're such old-fashioned lessons. But it is a case of the time you spend in the market is incredibly valuable. And if you start second-guessing markets and you start saying, well, I'm not getting a return, and we highlighted this, I think, about 3 or 4 months ago when we looked at the fact that you were barely covering inflation on the JSE over the last 3 years. And in some cases, you were actually going backwards in real terms, that the temptation would be for people to take their money out of the market. And we did caution, did we not, Warren? That this is the worst thing you could possibly do at this particular moment in time. And some people would have thought, idiots, they know nothing.
I think I might have received a few of those messages, and so what's interesting to contrast it with cash, just to give it a perspective now over time, the month of July you would have got somewhere around 0.6 or so, 0.7% interest on your cash. That would have been a good return, and as I mentioned, you would have got just over 7% from your shares. So that's, 1 month, it doesn't do anything. I know tomorrow's spring, but so it's not the beginning of summer yet. But if we look at a year then, so the JSE gives you around 7.6, cash has given you probably about 7.7 over that time. So what's interesting is to look at the 5-year number, and we always talk about 5 years and longer when we talk about shares, because the markets are so incredibly volatile that it's really not that worthwhile getting excited about 1 month. But just to give you a context, all of a sudden cash is giving you around 6.3, 6.4% a year over the last 5 years. And the JSE is doing what it's done for the last 114, 117 years, just over 13%. So if you take inflation at 6 and you say, well, shares give you somewhere around, 7% a year, 7.5% a year above inflation, we bang on those numbers again. for the long-term returns. And as we know, this has just not been a great time for share investors. So it's really, I guess I'm labouring the point, but it's impossible, I think, to sit here before the time markets, put your money in the bank and then wait for things to get ready or get better and then jump in and get your return. You're just going to miss out every time. And I think if we look at the month of August so far, I don't have the stats yet, but I think August is going to be another good month. If I just look at the values of things, they have gone up quite nicely again. So I'm not saying that this is now the beginning of a nice big bull run in the JSE. I mean, I think that would be foolish to say that, but investors are being rewarded for patience,
and that's absolutely pivotal. When one looks at, for example, the numbers around the tax-free savings accounts, and I forget the exact numbers. It was a story done about a month ago where the tax-free savings accounts were reflecting some very nice inflows, and South Africans were using the maximum allocations in these tax-free savings accounts, but more than 90% of the money was going into money market investments. Nice and safe, nothing controversial about them, other than you're not going to get any real great growth out of those money market style investments. You might get a percentage point or two above inflation, but you're not going to get the outperformance over a 20 or 30 year period.
And I think if those nice people at Treasury are listening, we should really ask them just to change the name. Tax-free savings investments or something, not accounts.
Well, yeah, because it's so deceptive, and it's actually almost forced a mindset is to thinking, it's a bank account.
It must be a bank account or a fixed deposit or something. Of course, it can be a pure share-based investment, right through property, etc., etc. And I think you mentioned inflation there, and I think that's the one. I always call it the silent killer in the investment world, where you don't get a headline or you or me raving about it on the radio to say, listen, watch out, your investments have suddenly lost value against inflation this week or this month. It slowly but surely eats away at the value of the purchasing power of your money. In other words, what you could buy now and what you can buy in 5 years' time is then just less and less and less. And you might never see the actual rand value of your money go down if you're sitting with too much cash. You might always see it go up, but what you can buy with that money becomes less and less. And that's the problem with inflation. It's just this real slow and steady, eroder of value. And I think that's the pain, unfortunately, that you have to take with investing in shares is you get that inflation protection if you're prepared for the uncomfortable, frustrating ride.
It's like taking a brand new car and going to park it next to a beach and leaving it there for 5 years. You're not going to notice the fact that gradually the car is beginning to deteriorate and the rust spots are beginning to appear. But by the time you realize that the car is becoming rusty and developing holes, and the rust is irreversible, and that's the same sort of idea as keeping your money in cash. You don't realize it until it's too late.
Geez, Bruce, that's deep.
I know. Hey,
that's a fantastic analogy. I'm going to steal that.
You can have it.
Thank you so much. So absolutely, and I think if we just look at what's going on, just to stay on the JSE theme for a second, a lot of people ask me at the moment, is it really worth investing in the Johannesburg Stock Exchange? Look what's going on in our economy, and no question that our economy's dire. Our beloved president doesn't seem to understand what's going on. He thinks it's just a financial crisis, and there are a lot of reasons to be bleak about the prospects for economic growth in South Africa. But what's interesting is, if you look at the companies, and I have to give credit here to a really good small companies analyst called Keith McLaughlin. He put it out on Twitter today, saying if you look at the growth of the profits of companies that have reported in June and July so far this reporting season, their profits are growing by about 10%. Year on year. Now that's interesting because they're clearly not just South African linked businesses only operating in the South African economy. These are businesses operating all around the world. And if you look at the rate of inflation and you say that's 5 or 6%, if these companies are generating profit growth of 10%, that's nearly double inflation. Eventually, that translates to a rise in their share price, which might be what we're seeing now, or this could just be another blip. But this is the vagaries of the market. Is you can't just link what's going on economically in South Africa to the JSE.
People get so perplexed. They look at the shenanigans in Parliament today. They look at the shouting match in Parliament today, which is a remarkable day for democracy. It really is. You might not like it, but the fact that we've got opposition MPs who stand up in Parliament and call the president all kinds kinds of names that he has to stand and patiently take it on the chin while ignoring the questions that come his way. It would be nice if it worked better. But all of this stuff, all this noise that happens in our society every single day, yet because of the way in which South African companies have diversified and globalized over the last 25 years, there is a huge amount of protection built in for investors in companies on the JSE, everything from Richemont to Remgro to a whole bunch of other companies. Even our banks, for example, are quite well diversified across the continent. MTN, we had Steinhoff this evening, which makes 52% of its revenues in Europe. All of these companies are global players nowadays.
And I just think about a business like Shoprite, which you talk about them sort of 4 or 5 years ago. They didn't have a huge number of stores outside of South Africa, and I was smiling when I listened to their original talks about their growth in Africa, saying we're getting 100% growth in Africa at the moment, and it was sort of going from 2 to 4 stores, and suddenly you look at that, and Africa becomes a really significant part of their earnings, and that becomes more and more of an international business, and if you go through the top 60 or 70 largest businesses listed on the stock exchange in South Africa, you have to say that they probably look more like an emerging markets index than just an index of what's going on in the South African stock market. So absolutely, I think it's one of those things where we've got to say these companies know how to operate in really difficult conditions in difficult countries with absolutely diverse regulatory backgrounds, but they also know how to do well when growth is constrained, and that's important. And I think going back to South Africa again, you look at some of the property companies here that have been reporting. They're actually doing okay in this difficult time. They actually can actively manage their businesses and adjust themselves to what's going on in this climate.
Claire in Pinelands with a question: can you confirm the annual ceiling for tax-free savings accounts? I'm with Standard. I went to put 33,000 Rand into my tax-free savings account, but they said they know nothing about a threshold increase. Am I mad? Well, we can't answer that question, Claire. I mean, that's we're not qualified to answer that question, but we can answer the question that yes, the threshold has increased to 33,000 Rand a year, although you can still put only a maximum of 500,000 Rand over the life of a tax-free savings account. Warren?
Absolutely. So it did jump from 30 to 33,000 a year, and as you say, the annual limit hasn't changed at all. The lifetime limit, hasn't changed at all. But absolutely, that's right. So maybe you just need to go somewhere else and put your money with people who know what's going on.
No. Be nice. And just consider more than just a deposit, Claire. I mean, one doesn't want to give financial advice on the radio and specific financial advice, but and the stock markets could fall on their face in the next 3 days, in the next 3 months, in the next 3 years. We have absolutely no idea. But take and have a listen to the podcast again as Warren talks about averages over time and how the financial crisis, if it taught us nothing, it taught us that panic is the wrong response in times of crisis. We saw the JSE halve almost in value over that period of the financial crisis, 2008, 2009, and since then has gone from 18,000 to 36,000 to nearly 60,000 on the all-share index. The JSE has gone up in multiples over that period of time, Warren. And so that it is a case of having faith that history does tend to repeat itself when it comes to markets. Sometimes you just have to be more patient.
I think that's the point, and it's always easy to try and talk about things in the past. It's amazing our stock markets, all stock markets, are so obvious in their cycles and what's happened 2-3 days after everything's happened. But unfortunately, that's not how life works. And I think what we do know is that markets really don't like drifting sideways. It's just not something that they do for long periods of time, and we've had that for quite a sustained period now. So I do expect it to change. But to talk about those tax-free savings, a nice rule of thumb is it's going to take you quite some time, probably 16 or so years to use your lifetime allowance. And so it really must be a long-term investment, in which case, having an investment that's largely invested in the stock market or the listed property market makes a lot of sense to me if you're not planning to use that money. And really, you shouldn't be putting money into tax-free savings that you plan to use in a 2 or 3 year period. It really should be for the long term, to let it really compound. And then, the growth compounds on itself, tax-free as well, and it becomes a virtuous circle, but you need to give it time.
Warren Ingram from Galileo Capital. Thank you, Warren Ingram, for coming in and sharing the wisdom of the markets.